Hi there, this is John Thompson, founder and lead advisor at SMPL Mortgage. This month, our case and strategies around blended rates. We call it blended rate reducer. And really, it's helping consumers understand how to take advantage of refinancing a low rate, because many people have very, very low rate firsts, along with maybe a higher rate home equity line of credit or second mortgage, and how you establish a target to do that. All right, so let's jump into this. So one of the challenges, that came out of, or will come out of this historically low interest rates we had a couple of years ago, are that everyone has really low interest rates. They don't want to give up, right? But they've built a lot of equity and they want to be able to use that equity and have been using that equity to accomplish other goals, home improvement, investments, and so forth. So they have low rate firsts. They're increasingly using home equity via second mortgage or home equity line of credit. If refinancing into a new first would create, potentially higher interest rates and a higher payment. So how do we then look at this blended rate, having a first and a second mortgage? There really is a blended rate. There's an overall cost of that money. And consumers really don't know how to compare this long and short-term impact of this and the risk and the payment shocks and all the rest of it. And so if there's other debts on top of it, including auto and car loans and credit cards, which is now increasing at a pretty significant pace, now we have another element to put into this analysis to determine what a good blended rate kind of might be. Looking at, where's the opportunity around all this, right? So constant interest rates, we know, are constantly kind of on the move. They move every single day. There's occasional opportunities to refinance if we have a dip in the marketplace or if something changes in the economy. You need to be working with someone that kind of watches that. So a good advisor is going to have their finger on the pulse of this kind of market, right? And the rates vary by the type of debt they have. So accurately assessing or calculating the blended rate really helps you figure out where it should kind of be. And then understanding the client's long-term goals and cash flow goals, of course, is going to lead to better decision making capabilities. Right, so a certified liability advisor, which is something that's a designation I'm very proud of, we examine the client's objectives, we analyze the debt, we look at the mortgage structure, interest expense, the remaining term of the mortgage, the balance, how it affects their cash flow, all the risks that have to do with payment shock and so forth, and then also consider the market conditions around home values and what's happening in the real estate market, looking at long-term, short-term objectives and all the rest of this. So we want to figure out, is it financially advisable to do a new refinance and blend this debt together or not? And if it's not currently, then how do we get to that number, right? So we interview the client, we analyze all the borrowing, the immediate borrowing, analyze the blended rates and so forth, and determine if there's a financial benefit or not. And so jumping kind of into a case study, this client's 58 years old, semi-retired, $650,000 home, a 367 mortgage balance with a very low rate at 2.979, but is using $175,000 on a HELOC to do renovation to the home. They'd like to keep the low fixed rate if it makes long-term sense. Right, so they want to remain, their goal is to remain in the home as long as possible, have stable fixed payments, reduce their cost of interest over time, and then look at a reverse mortgage when fully retired down the road, and should it consolidate debt. So we determined that today for the renovation, the home equity line of credit makes the most sense, secure that money and identify a rate for later consolidation. So at the end of the day, the client secured a $200,000 home equity line of credit. We established the blended rate reducer plan with the target rate. So the $200,000 plan is available at 10.25, of course, tied to prime rate, which can go up and down. The blended rate today is 5.444, which I'll show you in a moment. And then the target is set at 5% or below. So if rates follow that number, we will do a refinance. Now note that the home equity line of credit is variable. So as rates fall, it might fall as well. So we might need to reset that target as we kind of go through there. Then of course, as I mentioned earlier, we kind of looked at the reverse mortgage as a potential long-term solution for this client. Right, so here's the mortgage. You see the blended rate. You see the calculations here, 5.544. And so we established the rate down here at 5%. There's more to it. If there's other debts in here, then we'd bring other things into here as well and look at the overall debt and so forth. So kind of a great tool. So we really think this is an interesting way of helping clients. I think it's become a lot more relevant here over the next couple of years as rates fall again, as we go through an economic contraction of some kind, and there'll be opportunities for clients to improve cash flow and build wealth in other areas. So again, if you find this is an interesting concept, we do an analysis, we review it with you and clients, and then ultimately engage if it makes sense to engage. Thanks very much, and I appreciate you taking the time.